Yeah, so from a Q4 perspective, I think my expectations on revenue growth are broadly along consensus lines. I'm expecting about 2% constant currency growth for each of these companies. With a 20 basis point tailwind, you'll probably have a US dollar growth of about 2.2%. I'm expecting a flattish QOQ margin for TCS, whereas I'm expecting close to 50 basis point margin decline for Infosys on a quarter-to-quarter basis. So I think the key thing to watch out for going into FY20 is going to be the guidance and the commentary regarding growth and margins. I'm expecting Infosys to give a guidance of anywhere between 8 to 10% in constant currency growth and a margin decline, the band coming off by about 100 basis points vis-a-vis the guidance they gave in FY19. So the FY19 guidance was for between 22 to 24% EBIT margin. I think that's going to come off by about 100 basis points because of various things. It could the investments that they have to make, the fact that some of the large projects that they've got, some of the large deals that they've got, they'll be probably in investment phase in FY20. They'll have to invest in localization, they'll have to invest in subcontracting. So those I think will probably lead to a margin contraction by about 100 basis points. Whereas I think that TCS will probably hold on to a slightly lower margin compared to the aspirational margin of 26 to 28% that they've talked about many times in the past. So I think a 25% kind of margin is what they will deliver, but they will not be giving an explicit guidance on margins. My sense is they're probably going to come out and say something on the revenue side. If they do, and if they do say that they're going to do double-digit growth, it will be taken as a little bit of a positive, because right now Street is a little skeptical whether TCS will continue to deliver double-digit growth in FY20 also. So those are some of the broad markers for these two companies.
Girish, let's also talk about the margin outlook for both of these companies. You know, do you believe that the levers for margin defense are now steadily eroding? The rupee tailwind has receded. You have utilization levels which are considerably high. What is the margin picture that you expect?
So as I said, I think TCS will most likely hold on to its 25% margin. It will be between 25 to 26% for FY20, whereas I'm expecting that the margin band that Infosys has been typically talking of, the 22 to 24% for FY19, will kind of come off by about 100 basis points. So see, what's happened for Infosys is that in the 9 months for FY19, the total large deal, total contract value added has been 100% growth over the previous 9 months in FY18. But having done that, my sense is that there could be some bit of contract profitability issues, because I think some of these would have been won under very competitive circumstances, and typically these kind of deals involve rebadging of employees. It will require upfront investments. These typically happen in a price to win kind of a situation where Infosys or TCS, who wins the contract, has to do some back-end tweaking, be it from a delivery mix perspective, infusion of automation, employee pyramid tweaking, all that. And somewhere down the road, over the next 3 to 5 years, during the course of the contract, they'll come back to industry level, or they'll come back to the company level margins. But that's a back-ended situation. So I do see a situation whereby the very strong TCV growth that one has seen in Infosys in FY19 will potentially translate to a little bit of contract profitability related issues in FY20, which could mean some bit of margin pressure. So I'm expecting margins to be under pressure for Infosys, not so much for TCS. But having said that, I think Infosys will probably grow ahead of TCS a bit in FY20 versus FY19. So TCS delivered double-digit growth. I think that TCS will probably deliver single-digit growth in FY20. Whereas in Infosys, I think will probably nose ahead of TCS in terms of growth perspective. So the discount that Infosys traded at vis-a-vis TCS will probably narrow a bit going into, it's narrowed somewhat in the last few months. I think it will narrow further going into FY20.
Sandeep, just want to talk about, and we were talking about this last afternoon as well around closing bell. The entire issue of these FMPs and the SL Group exposure with both Kotak and HDFC Mutual Fund, can it really escalate beyond what it already has?
It could escalate if there are other such securities in FMPs which are yet to mature, which we don't know about. So, but the bigger picture, is that debt investments are supposed to be safer, and people invest in equity mutual fund. They see the portfolio, so they are willing to take that risk. Mid cap fund falls 30%, people are okay with it because it's an open thing. Like it can fall 30%, but FMP is sold as a quasi FD.
But what happens if they can't oblige that payment even in the deadline that they've given now, even though the SL group has given their reassurances, etc.?
So I think they are taking a stance that the principal, principal as in the AMC is not going to make up the difference. That's what at least publicly I have heard as of now. So to that extent, investors will lose out if that money doesn't come back. But I think in this, specifically for SL Group, my view is that people should not, if that's the only issue, then people should not panic so much, because the security that they have, they can realize at least, if not 100%, 80-90%, if they go out and sell in the market today. Because they initially also had a 50% buffer over the market price at which the loan was given. So I wouldn't be so worried, but I think it will raise question marks in the minds of investors that we wanted the money, because from investors' perspective they wanted the money today. So they are not getting it today, they are getting it after 6 months, but that might not work with the cash flows of those investors. So I think that's a bigger issue rather than whether that money will come back or not.
Yeah, because I don't think it was to the investors' discretion that you take on the debt of SL Group. That the mutual funds chose to do, and now investors are having to bear for it.
Yeah, and I think some AMC has actually extended the FMP also.
Yeah, one of the
380
two
days.
has,
So if you extend that, then that's sort of a breach of contract in a way, because people who are investing in fixed income, they want that money today. They might need it. So if you need that money and you are not getting it back, then that's a problem.
It's like, if I'm a borrower, I can say, look, I'm not in a position to pay the bank EMI because I have this problem, I have that problem, but that does not mean the bank will not demand it. I mean, it has to work both ways. Of course, with mutual fund industry, it's very nice that they always call themselves as a pass-on industry, which is that, look, we've invested, something's gone wrong with the market, what can we do? That's the product which we are in. But I guess a large part of problem lies, I think, even, as market commentators, we need to just make this messaging very right, that if you're buying debt, you also will be taking some risk. Debt is not safe. Debt is not fixed deposit.
Yeah, but risk not to the extent that you want to redeem and they'll say,
that's there. But Aisha, that
investments are subject to market risk.
No, but that is, if you look at the nature of the instrument which you're buying, that is the instrument you must understand. I mean, you may,
and the risk came out in 2008 also. You remember, so many, so many of the instruments had to be bailed out by the principals, the AMCs. So there was a lot of issue there. So in 10 years, people forgot, but then it's come back again.
Alan, I mean, and what tells you that this just stops at Z? I don't have any insider information to indicate that, look, there are some other, challenges groups, which promoter groups they will have. But this is a serious rethinking which a lot of people need to do, is that why was mutual fund industry giving it to LNFS? Why were they giving it to NBFCs? Why were they giving it to promoters?
Because of the entire focus on assets under management.
Exactly.
So people are incentivized, so the top management is incentivized on your ranking, how much you grew. So if that's how the incentives work, then this will always happen. So I think that incentive structure, so it's a bigger debate. I think the incentive structures need to change.
No, I guess, but I think prima facie, I always say this on TV also, that when you are investing in debt, there is a risk inherited. I mean, I never thought in my life I would see a day where the AAA bond rating of US would go down. But it went down. It created an impact that time when S&P came out. I mean, thankfully it didn't snowball into a crisis, so to speak. Anything could happen. Please remember, any investing which is not giving to in fixed deposit will always have in risk. When the going goes great, we don't talk about it, but when the tide turns, we figure out, who is naked. I mean, for example, in 2017 and 16 and 17, when mid-cap stocks were going higher, nobody talked about risk from a mutual fund industry. They wanted to sell mutual fund schemes. Nothing against mutual fund. I'm a big votary of mutual funds. But that's the way it is. So if you're buying any instrument, please understand the word risk, 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 risk. If you don't understand it, there's a problem. We got to stop this argument here and move on. But let's move on. We've got 3.5 minutes left, and then we'll get the first pre-open rates. We've talked about IT. We've talked about what's going on in the entire insurance space and the auto space. One space which I guess deserves some attention once again is, I think, NBFCs. When I say NBFCs, Chola, India Bull, Sundaram, some of the classic NBFCs, Bajaj Finance. I mean, looks like there is just no bear market in a stock like Bajaj Finance. Sandeep, a rising tide took every NBFC up, then the receding tide brought the weaker NBFCs down. Now the tide is reversing again, but not every NBFC stock has gone higher. Chola has recovered, Bajaj Finance has recovered, Sundaram has recovered. Are we looking at this kind of a TMT adjustment, what happened in 2000, where first all IT stocks went up, but when the tide reversed again after that correction, only 4 or 5 companies really emerged as winners?
Yeah, so I think if you look at Bajaj Finance near all-time high, if you look at even something like Manappuram multi-year highs, so I think the risk models are getting rewarded now, and that could actually continue because see, a lot of people are still buying this second generation, new, old generation private sector banks, looking at the movement of ICICI and Axis. Now, we do expect that those stocks should also move, but it's not necessary. We could have a phenomena where it just ICICI, Axis and some of the larger ones could keep on moving, and people will keep on buying those smaller ones, but then institutional interest won't come there.
Let's look at the data. So let's look at the 1-year chart of ICICI Bank and Axis Bank, and then we'll superimpose it with Karnataka Bank, Dhanlakshmi Bank. Lakshmi Vilas Bank is a special situation stock, so it does not make sense. You can throw in something like a SUC, City Union Bank, Cub, not SUC, sorry.
That's a show.
That's a show on ET now. So look at the changes there, and you will actually be surprised that Federal Bank, another classic quasi private bank with a very strong backing, not very big in size, but pretty decent in terms of reach and approach. None of these stocks have actually given you gangbuster returns. The temptation, Sandeep, is others have gone up by them. Is that a bad idea?
Yeah, that's always a bad idea, because that logic many times, and I would say most times, except in runaway bull market, doesn't work. So that's not to say we won't get the runaway bull market, because I haven't heard that mother of all bull market statement for a long time now.
Wait for the election.
So I think we'll see that also coming sometime. So if the big bull market comes back where everything and anything is running, then that argument will work. But based on that, why do you want to invest? Like in equity investing, you get so a 15% return is a very good return. So if you can find a stock 15%, then I think you should be satisfied rather than trying to go for 100%.
Yeah. Kunal, where do you see opportunities within financials? Manappuram, Mahindra Finance, all these stocks ran up yesterday.
So yeah, I think Manappuram Finance, Cholamandalam Finance, I think those are a couple of stocks which look fairly attractive. Shriram Transport also, I think if I can put that into basket. LIC Housing Finance, I think that's also one of the stocks which has made a very good comeback. The signs are very strong. You see their delivery volume spread across the last 3-4 months for LIC Housing Finance, and that's improved considerably. So the pattern the stock was making earlier of lower highs and lower lows, that has gotten breached. You see the improvement in terms of volumes, indicators on longer term charts. So I think even that has improved. So I believe it depends on the kind of trader sentiment, an appetite of a trader. If you're more of a stable guy or looking out for stable stocks, and I think Manappuram Finance could be one of the few stocks, because the stock generally doesn't go into strong periods of volatility. It is more stable in nature in terms of trends, and in terms of other potential breakouts, I think Shriram Transport and Cholamandalam Finance, I think, could be the other names which could continue to ride up higher.
Okay, a quick look at the pre-open quotes on your screen, and got a touch of green, yes, on the Nifty as well as the Sensex, so it's not looking too bad this morning actually. We're looking steady at these levels. Let's see how the opening session pans out. Remember, it's a big earnings day as well, so we'll be keeping our eye out on some cues coming in from there, as well as on some specific counters, lots of news and views that are coming in. We've been discussing some of those as well, auto, jet, so on and so forth. So, alright, let's also tell you some of the big voices that will be joining us on the show today. Let's run you through. Ramesh Sopti, IndusInd Bank, will be joining us with an outlook there. That's an important story that we are tracking for you today. We'll also have coming up for you Gautam Trivedi of Nepean Capital at 9:20. And on the rally, and finally Ravi Menon of Elara Capital on the tech report card as well. That's coming up for you a little later on the show today. Rajat Rajgaria of Motilal Oswal also sharing with us really strategies in this current market.